Hi Eloise and Pete, that is a terrific property there in Erbray, and I'm sure it will be on its way very, very quickly. Now, for those of you just joining us, with me in the studio at the moment, Tony Romano. Tony, nice to see you again.
Thanks, Tim.
Now, a couple of questions for you. Tom Regan has emailed in and asked about he as a first home buyer, what sort of deposit does he need and what other considerations are there for him to put himself in the best light to purchase and to be able to borrow money?
It's a good question, and good question by Tom. There's a number of things that people look at when they purchase their first home. Obviously, there's the first home owners grant.
Yes.
There's obviously
currently $7,000.
Yep, that's right. There's things like how much deposit do I need, and in Tom's case, generally 80% equity, 20% deposit is what we look at. So people borrowing above 80% of the valuation normally need to take out mortgage insurance.
Yes.
So mortgage insurance is an additional cost that basically covers the lender in case.
How much is that normally?
Look, it depends on the value of the property,
right.
But it could be in the vicinity of $5,000, $10,000, $15,000, depending on the value of the property.
So
the higher the value, yeah, absolutely, serious money. So a lot of people want to avert that cost if they can, or how do they do that? Initially, there's the ways people think, oh, there's no way to get around that, and the lender presents it to you that way, and you think, okay, I want to borrow 95%, and then you're stuck with this extra cost. It doesn't give you anything; it just covers the lender in case there's a shortfall in the sale.
Yes.
So, you know, we've got to look at ways to try and sort of help people out in that regard. And what a lot of people have been doing is using equity, for example, from their parents.
Right.
So their parents may own a home unencumbered. They either come in as joint borrower with the actual homeowner, first homeowner.
Yep.
Alternatively, they'll borrow money against the equity of their home using an equity loan, and they will put that in as deposit for the actual borrower as well,
right.
which will bring it below the 80% valuation on the price.
Yes.
And therefore meet the deposit requirements for the bank.
So that's interesting, because if you were putting money into your child's account, if you like,
yes.
and helping them with their deposit. Their equity,
yep.
That's pretty straightforward. But if you become a guarantor type situation, which is, I assume, the other way of going, you're liable if something goes wrong.
Correct, absolutely.
One of the things that I thought of struck me along the way, why wouldn't a parent say, well, I'll put a little bit of money in and I'll be just a percentage owner of the property along with you?
Absolutely.
Will that help push the borrowings required down?
Yep, it might. Look, it absolutely does, and it depends on how much they want to take of equity in that particular property. So that might be one option. The other option we talked about earlier on was the superannuation. I mean, your superannuation fund can purchase a portion of that property as well.
Okay.
So, you know, you might own 50% of the property in your own name.
Yes.
Your superannuation fund may own 20% of that property, for example. But then you've got to be careful, because the first home owners grant then becomes void, because it's not you're actually not buying it in your own name. You're actually buying it in 3 different entities.
And so what happens if you want to sell that property? You have part ownership in...
Yep, you can sell that share. You might buy it, depends on how you buy it, you might buy it as joint owners,
yes.
where the whole property has to be sold, or you may sell a portion, for example, you buy it as tenants in common,
yes.
and then you can sell a third or a half or whatever, but then you obviously, a willing buyer has to want to buy that property, or that share that you're actually selling them.
Right, okay, interesting. Well, hopefully that helps Tom with his details, and I guess the most important message for a first home buyer, I guess, nowadays is to have everything absolutely squeaky clean. The money, all his credit ratings should be absolutely spot on.
The important thing, Tim, as well is banks really look at income,
yes.
and the ability to service. So although the deposit's there, either it be through their own savings, either it be through their rental history, for example, where banks will look at that as a particular savings component, and they'll also look at equity put in by the parents, for example. That's critical, but the repayment ability is even more critical.
Paramount.
Absolutely. So not only do banks want to see that you have ability to be able to meet the repayments, but you also have the ability to meet all the other costs associated with living.
Yes.
Your children's education, your lifestyle expenses, etc.
Yep.
And you need to be able to cover those as well. So that banks don't want to be in a situation where they have to force sell homes. So they want to make sure that you're able to cover that and have an end strategy that at the end of the day, this is how I'm going to repay my loan.
Yep.
Whether it be through natural principal and interest reductions, or whether it be through sale of shares or taking out my superannuation when I retire and paying out the home loan, which a lot of people do as well.
Excellent.
Yeah.
Well, good advice. Tony, good to see you again, and
Thanks,
thanks
Tim.
for coming in.
Great to be here.
Been good.
Thanks.
Let's go now to have a look at some of our hot properties. Well, that's it for today's show, and don't forget, if you missed part of the show and would like to see it again, don't forget to look at our website, TOOP.TV, and download the podcast. And don't forget to tune in again next week for all of our finest properties that are available. So we'll see you next week on Wednesday at 1 p.m. And now here are some of our hot properties.